Hi guys, welcome to video 4, Distribution of Returns Spreadsheet class. I'm Chris Quill, the Institute's quantitative analyst, and you're going to be hearing a lot from me throughout the video series where, for the most part, I'm going to be kind of steering you through the practical quantitative sides of the processes that you guys need to understand. We'll be using Excel throughout, so no need to worry about any advanced programs or having any prior knowledge of any programming languages. And, if you are new to Excel, don't worry about that either, because I'm going to be teaching you what you need to know as we go along. And if you do get stuck with a particular aspect, then don't be shy, of course, to search for and use YouTube and Google to find solutions to the issues that you come across. There's a lot of information out there that can help you guys. For your reference, I'm going to be using Excel 2016 on a Windows PC. Why does this matter? Well, hopefully it doesn't make too much of a difference, and it shouldn't do. But if you guys are using different versions of Excel or are on a different operating system, you may see some very, very small differences in the visual layout of the Excel program that you're using, the version of Excel, and of course, if it's, for example, a Mac version or so on. But if these visual differences can't be kind of intuitively reconciled, then obviously you can find out the kind of answer to your problem via YouTube or Google quite easily. In this video, I'm going to be taking you through the practical steps of building a distribution of returns spreadsheet for any asset that you can get the data for. I'll be kind of reinforcing and practically demonstrating some of the conclusions that you've already heard from Anton in the previous video regarding volatility both across assets and timeframes, and kind of how that represents both risk but also opportunity for profit when you trade those assets. So taking a look ahead into the video, this is what we're going to cover. Firstly, I'll show you how to build a distribution of returns spreadsheet from scratch using an example asset, so you guys will feel confident in carrying out the process yourselves with any asset that you can get the data for. I'm then going to talk you through how to use some of the templates or some templates to help you with your analysis in the future. Those templates are going to be available in the download section for this video. And I should also point out at this stage actually that the first section of this video, so building the spreadsheet from scratch, there'll also be a PDF guide in the download section of this video to help you guys do that yourselves as well. Finally, I'll show you a quick example of how you can build a summary table for your distribution of returns values that you find across your different assets and different time horizons, a bit like the one that you will have seen Anton make reference to in the prior presentation. So lots of technical steps to cover with plenty of analysis to go with all of that. And all of the sections that I just kind of went through are really important to build your knowledge and, of course, your competency. So let's get started. All right, so as I said in the introduction for this video, what I'm going to do first is show you how to build a distribution of returns spreadsheet from scratch. And we're going to be using S&P 500 daily returns in this example. We're going to get the underlying prices from Yahoo Finance. And as always, the first step with any exercise like this is to obtain the data itself. So to do that, you just go onto your web browser and navigate to Yahoo Finance. You can find that through a search engine or typing in the URL directly. And then once you're on the Yahoo Finance homepage, you'll see a search bar at the top of the page. That's where we can input any asset that we're looking for. So in this case, I'm going to look for S&P 500, and you can see the top result there is the S&P 500 index. I can left click on that, and that will take me to a page for that asset. Now, from here, remember the goal of this video is basically to calculate returns and analyze those returns in terms of their distribution and the volatility. But to calculate returns, we need historical price data. So the next step is navigating to the historical data tab on this page. And then you'll be presented with all the historical prices that Yahoo Finance has for this asset. And we can change variables such as the time period and the frequency at which we look at that data. So the first thing that we're going to do on this page is change the time period to the maximum allowed. And we do that by clicking the drop down arrow here and then max. And you can see then that it changes the time period of prices for this asset to the range of 1927 to the current day. And we're happy with the frequency because we're going to be using daily prices and daily returns in this video. So from there, we can just click on apply to make sure the dataset updates. And once we've done that, we can then download the data by clicking the download link just there. Now at this stage, what happens next is going to be a bit different for each of you depending on the web browser and operating system that you're using. Basically, you just need to be able to navigate to the downloaded file and open it in Excel. The downloaded file is going to be a CSV file, so it should by default open in Excel. And for me, using Google Chrome on a Windows PC, I have the shortcut to that download given to me at the bottom of the page once I click download, and I can open that file from there by left clicking on that download. And then you'll see that it opens a new Excel workbook with all of that Yahoo Finance S&P 500 daily data within it. Now, the sensible thing to do here when you first open this sheet is to save it as a new name in a relevant place on your PC. So to do that, I'm going to navigate to File in the top left and go to Save As, Browse, and then click on an appropriate file within my PC and change the name of the file. In fact, first I'm going to change the type of file that it is from a CSV to a more standard Excel workbook, XLSX. Then I'm going to change the name of it to something that makes sense. Video 4 DOR exercise. Obviously, you can change this to whatever you want. This is just an example. I'm just illustrating that the first thing that you should be doing is saving the file as something sensible in a sensible place on your PC. So then we click Save. That's all done. So let's explore this data now that we've got this downloaded into Excel now. The first thing we should notice is basically the number of columns and rows of data that we have. So we have 7 columns going across, and the number of rows we have, if we take the scroll bar on the right hand side, left click and drag that all the way down to the bottom of the sheet, you'll see that we have 23,000 rows of data. And that represents all the trading days that they have, that Yahoo Finance has daily trading data for within that period back to 1927 that we selected. A quick segue here, just to point out something that you'll probably see me use throughout this video, which is shortcuts or keyboard shortcuts. You'll notice there that I navigated back to the top of this spreadsheet without using the scroll bar on the right hand side. You can do that by holding Control on your keyboard and then pressing one of the arrow keys. So for example, if I hold Control and down on the keyboard, that will take me to the end of the data set at the bottom. If I press Control and right, it takes me to the right hand side, left back to the left, and up back to the top of the data set. So you can use those shortcuts sometimes to speed up your work in Excel. So next, I just want to explain what we actually have in terms of data in these 7 columns. But just before I do that, you will have noticed already that in the date column, we can't really see the dates properly. They are shrouded by hashes instead of being able to see the date easily. The reason for that is basically the Excel column is too narrow to see the date. So the simple fix for that is just to expand the column width, and we can do that by putting our cursor in between the A and B columns, the intersection, and left clicking and dragging that column wider. That will basically make the A column wider, and then you can see all the dates appear. A quick note about these dates, obviously I'm filming this from the UK, so these are UK formatted dates. When you download files from Yahoo Finance, the dates will be in whatever format is suitable for your own destination, your own country. So no need to worry too much about that. Now, most of these columns are going to be fairly self-explanatory to you guys. Obviously, we all know what the date means. The open, high, low, and close prices here from column B to column E are the market daily open, high, low, and close prices. The adjusted close you may not be familiar with, and it's something that Yahoo Finance makes available, which is basically the closing price, so column E, adjusted for any dividends and splits. That becomes a little bit more relevant when you look at single equities, and it's quite useful. We'll be using the adjusted close column generally when we're looking at close-to-close returns. And then we also have the volume column in column G. Okay, so the final thing I want to do in this opening stage before we go on to cleaning the data and computing some time series returns is just to rename this particular sheet within the workbook. We can do that by right-clicking on this tab at the bottom of the page, navigating to rename, clicking on that, and then typing in whatever we think is suitable. So for this example, I'm going to type in S&P 500 daily DOR, standing for distribution of returns. Okay, so let's move on to step 2, which is cleaning the data and then computing some time series returns. We want to check the data set that we have for any errors whenever we download a price data set or any data set for that matter. And we want to then see if there's any manipulations that we need to make to that underlying data set as well before we start making calculations from that underlying data. Now, the first thing that I notice with this data set is that our date column, column A, is in a ascending order. And typically with financial and economic data, we like to view dates in a descending order. That's a preference. You don't have to do this, but it will affect how we do the calculations later. So I just suggest you do follow along with this. So we can change the date order to descending by clicking in the top row. So we can click in cell A1, going to data on the ribbon and then filter. You'll see little drop down arrows appear in each cell at the top of every column in our data set. And we can click on the drop down arrow in column A, so in cell A1 on date, and then select sort from newest to oldest. And you'll see there that flips the data set, flips all the corresponding prices in the adjacent columns, and basically makes our data set in a descending date order instead of an ascending one. We can now remove the data filter from our data set by just clicking on the same button in the ribbon, which is the filter button, and you'll see when we do that, it takes all those filter options out of those columns. Now, let's look at our data set a little bit more closely just to see if there's any changes that need to be made or we need to delete any data and so on. All of this data at the top of the spreadsheet looks fine, so the latest data, but I did notice when we downloaded the data previously, if we go down to the end of the data set, so the oldest data, we've got two issues that we can see. One is the volume column, column G, is 0. Now, actually, we don't need volume for this analysis anyway, so I think what we'll be doing is just deleting this column of data anyway. But the other more important thing to notice for this exercise is that actually our open, high, low, close, and adjusted close are all the same figure each day for these dates down at the bottom. So for these dates in 1927, 1928. Now, we'd expect adjusted close and close to be the same for the S&P 500 index. It doesn't need to adjust for dividends and splits, like you do need to kind of watch out for in single equities or ETFs and so on. So let's see when this price data, this intraday price data actually starts changing from each other. So, we'd expect to see a high, an open, and a low, and a close that are all different values from each other. And if we scroll up the spreadsheet, this actually doesn't start happening until 1962. So if we go up to around here, scroll down a little bit. Okay, so 1961 ends here. You can see the open, high, low, close are all the same prices. But once we get into trading data for 1962 and onwards, those prices change. So intraday trading data for the S&P 500, certainly through Yahoo Finance anyway, isn't available pre-1962. So to handle that, we're going to delete all the data prior to 1962. To do that, we can left click and drag a selection across that data from cell A 14,825 across to G 14,825. And then we can use a keyboard shortcut to select all of the data in that data set below that row by pressing Control Shift and down on the keyboard. You'll see that then highlights and selects all of those cells down to the bottom of the sheet, or the bottom of the data set, I should say, not the sheet. And then we can click delete on our keyboard. You can also right click within the selection and do clear contents, or you can delete the entire rows. But for this purpose, I'm just going to press delete on the keyboard. You'll see all that data then disappears. And as I said a few moments ago, we need to do something else to this data to clean it first, which is get rid of the volume column because it's unnecessary for the calculations and the analysis that we're going to carry out throughout the video. So to do that, we can select the whole of column G just by left clicking on the G at the top. That will select the whole column all the way down to the bottom of the spreadsheet. And we can just right click on G and then delete. And you'll see that column disappears. Now, the next thing we're going to do is calculate some time series returns. And you'll remember from video 3 that we have 3 different returns calculations that we look at for daily returns. We've got daily close to close returns, which is the percentage change of closing prices from one day to the next. That accounts for all price movements, both inside and outside of market hours. And then we've got 2 sets of intraday returns, one of which is open to close returns and one of which is high to low returns. And those returns calculations only use price data from within market hours. And you'll kind of see how that works as we go through and do the calculations themselves. So we're going to run these calculations in columns G, H, and I. So let's head these columns with some appropriate titles. So in cell G1, I'm just going to left click into that and start typing an appropriate title. So I'll put C-C space returns, press enter to enter that title in that cell or that text in that cell. On to the next one, H1, cell H1, I'm going to type in H-L standing for high to low, and then returns. Same thing, press enter, enter the text in. And then finally in cell I1, I'm going to put O-C for open to close returns. And there we have all the titles we need in cell G1, H1, and I1. Now, obviously, at the moment, we can see that the text is cut off in those cells. That's because the column widths aren't wide enough. So we can do the same thing that we did earlier with column A, the date column, and just click the intersection between these columns to expand them wider. Or we can also use a little shortcut, which is just double clicking the intersection between each of these, and that will automatically expand it to fit all the text within that column into the width. So for example, if I double click the intersection between G and H, it automatically expands it to the appropriate width. Same with H and I, same with I and J, the intersections between H and I and J. So let's start calculating some of these returns now, and I'm going to start by calculating the close to close daily returns in column G. We're going to be using an arithmetic returns formula, which is just going to take the percentage change from one value to the next. And I'll illustrate that with an example first in cell G2. So I'm going to type in that cell equals to begin with, because every formula that you enter into a cell in Excel starts with an equal sign. Then we're going to put open brackets. We're going to click on cell F2, which makes a reference to that cell. We're then going to put a minus sign, click cell F3, which makes a reference to F3, close the brackets, and then divide all of that by another cell reference, which will be F3. So basically, we're taking the close on the 17th of November, or rather the adjusted close, I should say, minus the adjusted close for the 16th of November, all divided by the adjusted close for the 16th of November. And that is the percentage change for that day from the close on the 16th to the close on the 17th. If I press enter now, you'll see that a number appears, a decimal value for the percentage return. And we're going to format that as a percentage shortly, but there's a couple of other things that we want to do first. So you might be asking here why in this formula we didn't just type in these numbers directly and we actually made a reference to these cells specifically. So instead of typing F2, we could have put in 3609.53. Well, for one reason, that would take a lot longer to do, so it's much easier with cell references. But more importantly, when we create these references to cells, and then we copy this formula down or across to other cells, it dynamically changes the references to the appropriate cells. And I'll show you how that works in a minute. Before we get to that though, let's calculate the high to low returns and the open to close returns. So in cell H2, I'm going to type equals again, open brackets, select the cell reference for the day's high, minus the cell reference for the day's low. So C2 minus D2, close brackets, divided by cell reference for the day's low, for the period's low, which is D2 again. Press enter, we get another decimal value. Again, like I say, we'll format that to a percentage shortly. Now in cell I2, I'm going to type our open to close returns formula, which is just going to be equals open brackets, make a reference to the closing price for the day, cell E2, minus the opening price for the day, cell B2, close brackets, divided by the open price B2. Now you'll notice in this formula that I've deliberately made reference to column E rather than column F for closing prices. So that's the close price rather than the adjusted close price. That is because when we're looking at open to close returns, we're interested in intraday returns. So we use the close price, not the adjusted close price. Now this returns column isn't going to be relevant to you if you're looking at weekly, monthly or quarterly returns. It's only relevant for assessing intraday volatility in daily returns. So that's why we're doing it in this example. So I'm going to press enter there, and that returns us a decimal value for the percentage return from open to close. So now we want to calculate the returns for these three columns over every trading day that we have in the data set. And the easy way to do that is copying down the formulas that we've created in cells G2, H2, and I2 down to the end of the data set. And this is where dynamic cell referencing comes into play. So for example, if I select cell G2, and then in the bottom right of that cell selection, you'll see a little green dot. If you left click and drag that down a few cells, you will see that it actually creates formulas in each of these cells for the close to close returns on any given day. So if I click into one of these cells, so for example G5 here, you'll see that it's dynamically changed the cell references to the appropriate day. And that's what I mean by dynamic cell referencing. It allows us to copy formulas both down a spreadsheet and across a spreadsheet very quickly and easily. So to make things even quicker than clicking and dragging this formula all the way down to the bottom of the sheet, we can actually just double click on that little green dot on the selection, and it will copy down the formula all the way to the bottom of the data set. Let's check that now. If we go to the bottom of the data set with Control and down on the keyboard, you'll see that it's copied that formula all the way down, but we do have an error in the final cell in this column, and that is a div0 XL error. So let's have a look inside the formula and just see why that might be happening. So if we click in the formula, you'll see that the reference that it's trying to make is to a blank cell. That's because it's reached the end of our data set, and when we do close to close returns, we require a previous day's close or a previous period's close. So when you're calculating close to close returns, you're always going to have to be aware that when you reach the bottom of the data set, it's not going to be able to calculate that final return or that earliest return, if you like, because we're looking at the earliest time period in the data set. So the easy way around that is just to clear the contents or delete that cell. So I'm just going to select that cell and then press delete on the keyboard. You can, of course, right click within the cell and clear contents. That's also fine. Let's go back to the top of the data set and copy down the formulas in cell H2 and I2 this time. So I've left clicked and dragged to select over those two cells, H2 and I2. And then I'm just going to double click this green box in the bottom right of the selection. That's going to autofill all of the formulas down to the bottom of the spreadsheet or the bottom of the data set. Let's double check what's happening at the end of the data set. These values look fine. The reason why these values are fine is because they're only making reference to prices on that particular day, not the day before. So we're not going to have any errors for those, so we can leave those as they are. Finally, before we get to the next step of the video, I want to introduce some formatting changes that we can make at this stage. The first of which is making the titles of all of these columns in bold. So if we select cells A1 to I1 by clicking and dragging over them, we can then go to Home on the ribbon and then left click this bold button here, and that will make those titles bold. You can also use a shortcut, which is Control B on your keyboard, to cycle between bold and unbold on those text values. Next, we're going to change all of the values in columns G, H, and I to format themselves as percentages rather than decimals. So you can do that by selecting those columns, G, H, and I, by clicking and dragging over them. Or you can just select the cells that you want to by clicking and dragging over those. But in this case, we want to format the entire column as percentages. So I'm left clicking and dragging over G, H, and I. I'm then going to right click within that selection that I've made and go to Format Cells. And then instead of the category in the number tab being general, I'm going to change that to a percentage to 3 decimal places. Press OK, and you'll then see that we've formatted all of those columns as percentage returns to 3 decimal places. The next step is going to be to create a histogram table and chart, which essentially tells us how many data points lie within specific intervals. Now, you've already seen these in the previous presentation with Anton, and you can read more about them in the Introduction to Statistics PDF download if you wish to. But basically, they're useful to us because they allow us to visually assess the empirical probability of various ranges of returns occurring. So we get to learn about how the asset that we're looking at behaved in the past, its volatility, and hence both the risk and opportunity in trading the asset over the time horizon that we're analyzing. So in this example, on a daily time horizon. So the first thing we want to do is define some intervals, and these intervals are going to act as the bounds for the ranges of returns that we're going to analyze. So to be clear, for example, we might create an interval that is -2% and -1%, and we're interested in analyzing the returns between -2% and 1%. And what I mean by analyzing them is basically counting the frequency of occurrence that we get trading days with those returns out of our entire data set. All of this is going to become a bit clearer as we go along with this practical demonstration. But one thing I do want to point out at this point is that when you come to do this yourselves with different assets, and looking at different time frames like weekly or monthly or quarterly time frames, the definition of your intervals needs to change with respect to the volatility of those assets. So you're going to need wider ranges for assets with more volatility and time frames with more volatility, so wider ranges for longer time frames. This is going to become a bit clearer again when I get later into the video and we talk through the template files that I've built. So I'll come back to that. For now, let's crack on with defining some intervals for this part of the practical. So I'm going to click into cell K4 and I'm going to type our first interval, which is just going to be -2%, which in decimals is -0.02. The next interval will be -0.01, 0.015 rather, and I'm going to put that in cell K5. That's going to be -1.5%. And then what we want to do is use the same stepwise change of plus 0.5% between these two values as many times as it takes to get up to a maximum of 2%. And Excel gives us a neat little trick to do this, or to help us with this. So what you can do is select those two cells, K4 and K5, and then drag down as we did with copying a formula down by left clicking on the little green box in the bottom right of the selection and just dragging down. And as I said, this is going to act like we're dragging down a formula, but we don't have formulas in these cells in this case. So what Excel is going to do is quite clever. It's going to realize that we've got static values in those two cells with a stepwise change, and it's just going to extrapolate that stepwise change downwards as far as we want it to go. So you can see as I pull the cursor down, the value is changing next to my cursor. So I'm just going to pull this down to whatever cell equals 0.02. So that's cell K12. And when I let go, you'll see that it's filled in static values that have a stepwise change of 0.5%, all the way from -2% up to +2%. So now we've defined our intervals, let's give them a quick title. I'm going to select cell K3, and in that cell just type intervals and press enter. And now we can move on to some analysis. And the analysis we're going to do is count the number of trading days where returns lie within certain ranges as defined by our intervals. And Excel has a good little tool to help us with that. But before we go any further, just want to point out for this practical demonstration in terms of building this spreadsheet from scratch, we're only going to go through the analysis and building of the spreadsheet for close-to-close returns, because the process is so similar for high to low returns and open to close returns. You'll be able to do that yourselves and practice on those columns yourself. Not only that, but by the time you get hold of the templates and other files, you'll be able to see and mimic exactly how the spreadsheets were built for all of the columns of data over all different ranges of returns and different frequencies as well, frequencies of data, so daily, weekly, monthly, quarterly, and so on. So let's crack on with analysing these close-to-close returns in column G. So as I said, Excel has a neat little tool to help us count the frequencies of returns between all these intervals that we've defined, and that is the data analysis tool. To find that, go to data on the ribbon, and then you should see a data analysis button on the right-hand side over here. Some of you, however, will not, which is why I've deliberately turned off the tool for myself so that I can show you how to install that tool for yourself and then use it afterwards. So let's now go to File, Options, Add-ins, and then click Go next to Excel add-ins down here. And then just make sure the Analysis Toolpack and Analysis Toolpack VBA checkboxes are checked and press OK. What you'll then see is within the Data tab on the right-hand side, you'll see a Data Analysis button. And when we click on that, we can then continue with the next part of our analysis. So from this dialog box, select histogram and press OK. We're then prompted to input a range. What this means is it wants to know the range of returns that we're looking at, the range of data. So this is going to be from cell G2 down to the end of the data set in column G. So I'm just going to select G2, press Ctrl Shift and down on the keyboard to quickly select all of those returns within that column. Then scroll back up to the top of the sheet using the scroll bar on the right hand side. Then going to input a bin range. Now our bin range is just the intervals that we've defined, and that's why we had to define those intervals first before using this tool. So I can just select all of the cells from K4 to K12 within the bin range box. And then finally, before we press OK, we want to tell the program where to output this data. So I'm going to select the output range checkbox. And then within this box over here, I'm just going to select cell L3 and press OK. So what that tool's done for us here is essentially count the number of trading days where the returns lie between the ranges that we've defined in our intervals. So to be clear, because it's not obvious from that table that it's just shown us, the first cell here, M4, in the frequency section, the value is 376. that value means that there's 376 trading days where the returns are less than minus 2% on the day. So close to close returns because we're looking at column G. In the next cell M5, we have 400 trading days where the returns lie within the range of minus 2% to minus 1.5%. And then that continues onwards all the way up to cell M12, where, for example, we have 398 trading days where the returns lie within the range of 1.5% to 2%. And finally, in cell M13, there are 369 trading days where the returns are greater than 2% from the close to the close. So because that's not obviously clear, I think we should create an adjacent column that kind of says what the ranges are more explicitly. So in cell N3, I'm just going to type range. And then what I'm going to do in the cell below is type in text the range of returns that corresponds to the frequency in the adjacent cell. So in this case, in cell N4, I'm going to type in text the range of returns for which there are 376 trading days that lie within that range of returns. So in this cell, I'm going to put equals, and there's a reason why I'm going to drive this with a formula as opposed to typing it straight in, and I'll get to this shortly. But I'm going to put equals and then open quotation marks less than minus 2.0%, close quotation marks, and press enter. For the next cell, I'm going to put equals quotation marks minus 2.0% to minus 1.5%. I'm just going to keep doing this all the way down to cell N14 so that we can see the ranges of returns a lot more easily than just trying to figure them out from the bin range or the interval range. Okay, so now that I've done that, let me explain why I did this formulaically with an equal sign and quotation marks, as opposed to just typing in something like less than minus 2.0%. So that works fine for that first value, less than minus 2.0%. But as soon as we get to minus 2.0% to minus 1.5%, Excel's going to get confused because we've started this value with a mathematical operator and it's not going to be able to resolve it as a mathematical equation because it has text in. So you'll get an error that looks like this. And that's why I entered everything as a formula with quotation marks. Okay, so that's the hard work done for our histogram table, which will kind of turn into a chart later on in the video. And we can already get a little bit of a feel for how this asset behaves and its volatility just by seeing the number of trading days that have returns that lie within these various ranges. But before we go any further, I think we should crack on with understanding a bit more about the data by calculating some descriptive statistics. And we're going to use the same data analysis tool as we just used for the histogram calculations. So I'm going to click on data analysis again on the data ribbon, and this time select descriptive statistics and press OK. The input range is going to be the same as we use for the histogram. It's going to be our close to close returns in column G. So to put that in the input range box, we're going to select cell G2, press Ctrl Shift and down on the keyboard, and that will select all the data down to the end of that column. We then want to scroll up to the top of the sheet again with the scroll bar on the right hand side. We want to make sure summary statistics are checked and change the output range to cell K15. So I'm just going to select the box here and then put in K15 here and then press OK. So that gives us our descriptive statistics table there. And as it stands, everything that we've kind of created analysis-wise is a little bit difficult to interpret because we need to make some formatting changes really to make sure everything's clearer. So let's go ahead and get some of that out the way now. The first thing we want to do is rearrange, or rather than rearrange, readjust the column widths to make sure that all the text and values actually fits in each cell in that column. So I'll start with column K, drag the width out to whatever we need to, about there looks fine. We'll do the same for columns L, M, and N, and I'm just going to do that much quicker by just double clicking the intersections as I've done there. Next, let's change the formats of some of these numbers. So if we go back to the histogram table just briefly, all of these intervals and bin values are in decimal places, and actually it makes more sense to display them as percentages. We don't really need to do this, but it's just something that you might want to do if it makes more sense to you. So I've selected all of those cells there from K4 to L12, and I'm going to right click within that selection and go to Format Cells, and then change the category in the number tab to percentage to 2 decimal places and press OK. Now let's turn our eye to the descriptive statistics table down here. First thing we want to do is rename this table from column 1. I don't know why it's named that by default, but we want to rename that by clicking into cell K15 and just typing over it with descriptive statistics. Press enter. And now we'll have a look at all of these values down here in these cells. We'll tackle the formatting of these cells first. So for every cell down to kurtosis and skew, we want all of those to be formatted as percentages. So I've just selected all of those cells. I'm formatting them again. Category number, percentage. We'll choose to 3 decimal places for this. Kurtosis and skew can both just be left as numbers, but we don't need them to all those decimal places. So I'm going to go into category number and just change that to 2 decimal places for both of those values. Range, minimum and maximum, we can change to percentages. I'll select those cells, right click within the selection, format cells, number, category, percentage to 2 decimal places is fine. Actually, let's make it 3 so it's consistent with the ones above. And finally, the sum value, again, doesn't need to be to all of those decimal places. Let's change that to 2 decimal places. And this 0 at the bottom of the table, again, I don't know what that's doing there. That doesn't seem to serve any purpose to me. Let's make sure we delete that as well. Okay, so let's go through some of the descriptive statistics in this table. Some of these you should be familiar with from your Introduction to Statistics PDF download that we've made available, but I do just want to go through some of these just briefly now. So starting with the mean is just the average return that we see in our data set. Remember, our data set is the close-to-close returns in column G. The standard error is essentially a measure of variability of the mean, given the mean is calculated from a sample of a larger population. Don't worry too much about what the standard error means. We won't be referring to it in general throughout the video. The median is another measure of centrality along with the mean and the mode. The median is the middle number in a data set. So if you had a data set of 5 numbers, let's say those numbers are 1, 2, 2, 4, and 5. The middle number would be 2 because it's the third number. So that would be the median. The mode is the most frequently occurring value in the dataset, in this case 0%. Our next 2 values, the standard deviation and the sample variance, are measures of variability of the dataset. So starting with the variance, that is basically the sum of the squared differences from the mean for each data point. And the standard deviation is the square root of the variance. Now, I'm not going to go into too much more detail in terms of explaining that here. If you don't understand these concepts, then you'll be able to, once you look in a bit more detail at the Introduction to Statistics PDF. One thing also to note here is that a standard deviation is probably the most common measure of volatility when it comes to financial asset prices and even economic data as well. Moving on, we've got kurtosis and skew. So these only mean anything if you understand what a normal distribution is. Again, if you don't, then go back to the Introduction to Statistics PDF to understand a bit more about what a normal probability distribution is. A normal distribution has a kurtosis value of 3 and an excess kurtosis value of 0. And Excel calculates kurtosis in the form of excess kurtosis. So this dataset has an excess kurtosis of 20. What that essentially means is that the dataset is a lot peakier and has a lot fatter tails than a normal distribution would have. And you've seen that a little bit through the slides that Anton's talked about as well in the previous video. The skewness value is negative. A normal distribution has a skew of 0. So a negative skewness basically means that extreme negative values are more likely to occur than a normal distribution would predict. Moving on, we've got the range, which is just the range between the minimum and the maximum values, maximum data points in our data set. So if we go down to the minimum, we can see that the minimum return over any day in our data set is minus 20% or so, and the maximum is plus 11.5%. When you add those two, when you take the difference between those two values, you get a range of 32%. Next, we've got the sum. The sum here does not mean anything. You don't need to worry about trying to interpret this value. I want to point out that it does not equal the return of the index over this time. So the index hasn't returned 473% over this period. If you did think that was the case, then you're probably getting confused with geometric returns, which you can add together to give you the total index return over a period. But we used arithmetic returns for all these calculations. So just to summarize, this value doesn't really mean anything to us. You can ignore it. And then finally, the count is the total number of data points in the data set. So in our case, this is the number of trading days that we have close-to-close returns for. So that is all the data points that we have in column G. Okay, so now we've got the basis of our histogram table data and we've got our descriptive statistics as well. The pieces of the puzzle are really starting to come together in terms of understanding how this asset's behaved in the past, its volatility over the time periods that we're analysing, and therefore the opportunities that come with trading that asset over that time frame. As a reminder, we're looking at S&P 500 data on a daily basis. We've got a fairly low mean, close to 0% on a daily basis from close to close, and a 1% standard deviation. We also know a little bit about how the distribution looks because we know the skewness and kurtosis values, and we know how that means the distribution differs from a normal distribution. We get a little bit more detail when we look at our histogram table because we know the specific frequencies of data points that lie within certain ranges. And that's what we're going to expand on now, just to help us more easily interpret those results. So the way we're going to do that is by translating all of these frequency values to percentages by dividing them by the total count that we see in descriptive statistics. So for example, we know we have 376 trading days where the returns are less than minus 2%. We're going to find out how many trading days that is as a percentage of our entire data set. And that just gives us more easily interpretable results. So to do that, I'm going to head column O in O3, cell O3 with probability. I'm going to expand the column width a little bit by dragging out the intersection of O and P. And then in cell O4, I'm going to type equals because we're going to put in a formula. I'm going to make a reference to cell M4 by clicking on cell M4, and then divide, which is a slash on the keyboard, divide by cell L29, which is the total count for our data set, the total number of data points. Before I continue, I do actually want to change this reference slightly, L29 in the denominator of the equation, by putting in a $sign before the L and a $sign before the 29. And that is basically Excel speak for saying we're going to fix the reference L and the reference 29. So basically we're fixing that cell reference entirely. That means when you copy this formula down or across, the L29 part of this formula will not change. So let's enter that in now, and we'll see that's why that's useful. And then we'll copy this down all the way to cell O13. We now see that when we click in, for example, cell O6, we have M6, which is the correct frequency reference, divided by L29, which is the correct total count reference. So we're still getting all of these as probabilities or percentages of the total count. The reason why I've headed this column as probabilities is because by working out the percentage chance of these values occurring in the entire data set, we're kind of implying empirically that there is a probability attached to that. And what we'll then do is, once we've got these values, they're all in decimal places at the moment, decimal values rather. If we select all of them and right click within the selection, we can go to format cells and change those to display themselves as a percentage. We can do that just to 2 decimal places. And then we can start saying things like, there is a 2.5% chance that the S&P 500 on a daily basis returns less than minus 2%. Or there is an 11.89% chance that the S&P 500 on a daily basis returns between minus 0.5% and minus 1%, and so on. So you can see why translating these frequencies into percentages and hence empirical probabilities is useful to us in terms of our analysis. It gives us an even better understanding of the kind of returns that you can expect in this asset, and hence the volatility and the distribution of these returns as well, which we're going to go into very shortly with a chart. Before we do that, I do want to add another column of data in column P, which is going to be the cumulative percentage or cumulative probability. So I'm going to expand column P already, and I'm going to head the column in cell P3 as cumulative probability. And this is just going to be the cumulative percentage or probability values from column O. So in column P, in cell P4, I'm going to type equals O4. In the next cell down, I'm going to put equals O5 plus P4 as a reference. So it's going to add in the probability of this range of returns occurring plus the probability of the range before it occurring. If I copy that down, something interesting happens. We develop a cumulative probability distribution. So how does this work and what does it mean? Well, the cumulative probability distribution works by taking the probability of the lowest range of returns happening and then sequentially adding the probabilities for all the rest of the ranges of returns happening beyond it. So that's why we start with 2.54%, and then sequentially we're actually adding these probabilities from these other ranges until finally we account for all the data, and that's why we have a value of 100%. So why do we care about calculating this cumulative probability? Well, it's just another way to analyze the data. We can say things like, for example, 10.67% of the data has returned less than minus 1% on any given day. Equally, we could say something like 97.5% of the data has returned less than 2% on any given day. So just another way to basically analyze the data and understand the asset that you're looking at a little bit further. The next stage we're going to tackle is all about presentation, because at the moment the data tables that we've created look a little bit dry. So I think we can just make this look a little bit better if we add in some borders to start with. So that's how we'll begin. First of all, let's select all the cells in this histogram table. So from cell K3 to P13 by left clicking and dragging over that selection. Then we can go to the Home tab and add some borders. So the border button is over in this part of the ribbon on the left hand side. And to begin with, I'm going to click this drop down arrow and remove all the borders that we currently have in these cells. And each time I do this, so I've just left clicked no border there. Each time I do this, I'm going to left click off the selection that I made just so that we can see the change that we've made as we go. So that's just removed the few borders that we had in these cells over here. I'm now going to reselect that table and add in all borders. If I click off, you'll see what that does. Basically adds a thin border to every cell in that selection. And then finally, just to make this look a little bit better, we're going to add in a couple of thick borders. So I'm going to add a thick border around the whole table. So I've selected that data again. I'm going to the border drop-down menu, and this time I'm going to click thick outside borders. And I'm going to do that once more actually by selecting all the data, not including the titles at the top. And instead of going into the drop-down menu this time, I can just click this shortcut here for thick outside borders, and that's just because it puts the shortcut for whatever border option you last used in this part of the ribbon. So I'm just going to click that there, and you'll see that that's tidied up our data quite a bit. Okay, so let's now create a chart so that we can more easily visualize this distribution of returns data that we've created up here in this table. I'm going to start by clicking any random blank cell, which in this case is going to be N15, and then going to Insert on the ribbon. And within that tab, you'll see that in the middle of the ribbon, there's a bunch of options for creating charts. I'm going to click on the top left drop-down menu, which is inserting a column or bar chart. And once I've done that, from the next set of options, I'm going to click on the top left chart, which is a 2D clustered column chart. Once you do that, you'll see a white blank space appear in the middle of the spreadsheet. That's our new chart area. You can left click and drag that around the spreadsheet to move it around to wherever you want to. I'm going to move it to the right hand side of our descriptive statistics table. And while that area is still selected, we can right click within it and go to select data. And from there, a dialog box will appear and we can select the data that we want to visualize in the chart. To do that, if you look at the option on the left-hand side, it gives us a chance to add a series, and that's what we're going to do. So I'm going to click on the Add button here. And then in this new dialog box for editing the series, I'm going to leave the series name blank. I'm going to delete this equals 1 value in our series values box. And I'm going to then select the values that we want to visualize, which is basically our frequency data. So all the data from M4 to M13. So I'm just going to left click and drag over those cells whilst in that series values box, and then click OK. You can see there that it's updated our chart area. It's put in that new data that we've specified, so our frequency data, and it's automatically created this vertical axis, which acts as the frequency of occurrences of different ranges of returns happening. What it hasn't done is recognize our labels for our horizontal axis, which is going to be our ranges of returns. So we need to specify that in this dialog box again. So we can go to the right hand side of this dialog box this time and click on Edit the horizontal axis labels. In the new dialog box that appears, we'll change the label range to cells N4 to N13, and that is going to be the text ranges that we defined earlier. And this is one of the reasons why we wanted to create that text range earlier. Obviously, it made things easier to understand back then as well when we were just looking at the data in this table, but also it serves the purpose as acting as very easily understandable labels for this chart as well. So I'll click OK there and then OK again. So all the major information's in this chart now that we need. The only thing that we can kind of improve on is the presentation. So let's go through a few things in terms of how you can change the presentation of charts. First thing I want to do here is left click on this box here, chart title, and then just press delete on the keyboard to get rid of that chart title. It's a bit unnecessary because we know what the chart's actually displaying. But I do think it would be useful to add in some labels for our horizontal and vertical axes. So to do that, you want to make sure that you're in the Design tab at the top of the Excel file. You should already be there because you've got the chart area selected. And once you're in that Design tab, there's an option on the left-hand side of the ribbon to add chart elements. And that's where we can add our axes titles. If you go down to this axis titles option, and then across to the right, you'll be able to add either a primary horizontal or vertical axis title. We're actually going to do both of those. But let's start by left clicking to select the primary horizontal axis title. You'll see once we do that a title appears below our ranges of returns labels. At the moment, this title is just called axis title. If we kind of left click and drag over that text, we can then delete it and change that title to whatever we want it to be. So in this case, something relevant would be something like close to close, daily return range. And then we can just left click out of that title back into the chart area so that it's input into the chart. Okay, so let's do the same for the vertical axis. We go to add chart element again, axis titles, this time primary vertical axis title. Left click that. You can see that the chart titles appeared on the vertical axis, and the text has been rotated upwards. That's fairly standard for vertical axis titles. So if you just left click and drag over that text, you can delete it on your keyboard and then type in something relevant. So this might be just frequency or occurrences if you prefer. We can left click out of that into the chart area again. That inputs that vertical axis title. There's one more thing I think we should do to be able to visually assess this chart very easily, and that is basically change how these ranges of return labels look. At the moment, it's quite difficult to understand what the range of returns is for any given bar, and that's actually because the text doesn't really fit under each bar. So one way to get around that is if you left click on that text, so on those labels, you'll see a little box appear around it that lets you know that you've actually selected those labels. Once you've got that selected, you can go to the Home tab and select this text orientation option up here on the ribbon, click the drop down menu, and then what I tend to do is angle this text counterclockwise, and you'll see what this does. So if I left click on that, you'll see that it then fits all the text kind of under each bar by angling it counterclockwise. It just makes it a lot more readable for the user. So the chart's pretty much done now. The only thing you might want to do is just add some color, which I tend to do. I tend to make these charts a darker color. So with the chart area selected, you can right click within it and then go to a fill option. So shape fill, you can left click on that and just click on any color we want from these theme colors. For me, I choose something dark, like a dark gray, maybe something like this. Left click that, and then obviously at the moment that makes it less readable because our text is all grey as well, and also our horizontal grid lines kind of jump out a little bit too much. So let's fix the grid lines first. If we right click on the chart area again and go to Format Chart Area, you'll see some options appear from the right hand side of your spreadsheet. And then what you can do is left click on the grid lines that you see, and the options for those grid lines in terms of color and transparency and thickness and anything else, they're going to appear, the formatting options are going to appear on the right hand side. So what I do here is just make the grid lines a kind of dark color again, a similar gray, but maybe slightly lighter, just so that they don't jump out as much. Something like that. Possibly something else. Maybe that looks good because they're quite faint, but you can still see them. And then that just kind of improves the look of the chart. And finally, we want to make sure that all our text is white or a color that just stands out very nicely. So to do that, you can click on the elements of the chart that you want to change. So for example, if we click on our vertical axis labels, that puts a box around that selection. We know that means that we selected that box. And then on the home tab, we could just change the font color using this option up here. Click the drop down box and then select white. We can do the same for all of our other labels and titles, just by cycling through them, left clicking on them, and then going back to changing the text color to white. So those coloring options obviously aren't necessary. It's just a kind of visual preference. I just wanted to show you that there's a bunch of options that you can choose from to kind of customize your charts and get them looking exactly as you want. So now we've created this chart, it gives us the chance to make a really easy kind of visual assessment of the data that we've already got in the frequency table up here. It's fairly easy to see that our distribution of returns are roughly bell-shaped, which is somewhat normal. But we do also know from our descriptive statistics that because there's a positive excess kurtosis and a negative skew, we know that it's not completely normal, and we kind of know what that means as well. So at this stage of the analysis, I think we've got a pretty good understanding of how the asset behaves, what its distribution of returns looks like. We have an idea about its volatility and also its mean returns from its descriptive statistics as well. So we're well on the way to analyzing and understanding this asset. So let's now take this a step further by looking at the positive and negative data points individually and analyzing them, and then looking at our returns distribution in terms of standard deviations and comparing that to what a normal distribution would look like. So again, like I said earlier in the video, if you need to brush up on what a normal distribution looks like or what a normal distribution is, then take another look at the Introduction to Statistics PDF. So what we're going to do next is build a positive and negative return analysis table. And to start this off, I'm just going to create the headings for the table, and then I'll kind of let you know what we're dealing with and how it all works afterwards. So in cell L31, I'm just going to type the title average returns. In the next cell, M31, I'm going to put count. The next one along N31, I'm going to put frequency percentage, and then in O31 I'll put frequency adjusted return. Moving on to K32, I'm going to type in positive data points, and then in the cell below negative data points, and then finally the cell below that will just be called 0. Before we go any further, let's just adjust the column width so we can see all of these text titles that we've just entered properly. So I'm going to select columns K through to O and just double click any of the intersections in those columns, and it will automatically adjust all of the column widths appropriately. And now we can see these table titles that we've created. So what we're going to do here is basically split up our analysis by using only either positive data points, negative data points, or 0 values. And we're going to work out the average returns for the positive and negative data points in our dataset in column G. The count, so the number of times we get a positive or negative data point. What that means or translates to in terms of a percentage frequency of the total count that we have in our entire dataset. And then we're going to work out something that's called either a frequency adjusted return in this case, or a probability adjusted return. And I'll show you how we kind of do all of that as we go. So let's start with average returns. So in cell L2, what I'm going to do is type equals average if. Now average if is a function in Excel. When we deal with functions, We open brackets afterwards, and then it gives us some criteria to fill in. So it's asking us to input a range and then a criteria and then an average range if appropriate. So basically what we want to do here is average all the data points in column G, which is our close to close returns, but only if they are positive. So in range, I'm going to just click on column G, and that will put a G:(G) reference in there. Then I'm going to enter a comma and put in the criteria. And the criteria is going to be greater than 0, because that would mean that it's only going to average the points that are greater than 0 returns, which is all of our positive data points. To do that, we need to actually put quotation marks, then put a greater than sign on the keyboard, and then 0, and then close quotation marks, and then we can close the brackets off. And basically what that's going to do is average all of the data points in column G as long as they are over 0. So basically as long as they are positive data points. We can do the same thing for negative data points, equals average if, this is in cell L33. We click on the same column because it's the same range of returns that we're looking at, or sorry, the same returns column that we're looking at, column G. So G:(G) is the range, comma, criteria, this time quotation marks less than 0. So that's the less than, the mathematical operator for less than 0, close quotation marks, and then close brackets. And we've got our average returns there for all our positive data points and our negative data points, and we'll format those to a percentage shortly. But before we do, let's work out all the formulas for the rest of the table. So our average returns for 0 data points, this is obviously going to be 0, but let's put this in anyway, equals average if, open brackets, choose the column, the returns column, column G, comma, criteria is just going to be 0, and then close brackets. So that's only going to average any of the values if they're equal to 0. Obviously, the value, the average of any number of zeros is still 0, so we know what it's going to return there. Let's move on to count. This is actually going to be quite a similar formula, except we're just going to change the function we're using from average to count. So I've put in here cell M32 equals count if, open brackets. And the way this function works is very similar to the one we last used. We just choose the range that we want to count within and then set a criteria that we want to count for. So open brackets, the range is still column G. We're still looking at close to close daily returns. I can select that column, press a comma, and then put in a criteria. Our criteria is going to be, again, in quotation marks, greater than 0, close brackets. So we have 7,839 data points or trading days for this data set where the returns are positive. Let's see what it is for negative. Equals count if, open brackets, choose column G returns, comma, in quotation marks, less than 0, quotation mark, close brackets. And I've made a little typo there in that function, count if. There we go. So we have 6,933 trading days where we get negative returns on the day. Let's see if we have any zeros. So in this formula, I'll just put equals count if again. So I'm in cell M34 here. The range is the same, still column G returns, comma, the criteria this time is just 0, close brackets. Okay, so we have 50 trading days where the returns are 0 from the close of the previous day to the close of the current day. Okay, so that's all well and good, but we can glean a bit more information from it, or a bit more understanding from it, if we display these numbers as a percentage of the total count. So that's what we're going to do in the next column. So in cell N32, I'm going to put equals make a reference to cell M32 divided by cell L29. And I'm going to fix this reference. Remember I talked about putting dollar signs around the column letter and the row number. What we can do is press F4 on the keyboard and it will cycle through the various ways of fixing that cell reference. And let me cover that just very quickly now. So basically, if you don't have any dollar signs within a cell reference, it's going to be completely dynamic. When you copy formulas across, then the cell reference will change across the row appropriately. And the same with if you copy a formula down. If you press F4, it will then fix the reference completely by putting a dollar before the column letter and a dollar sign before the row number. That just means that both the row and the column are fixed. If I press it again, the dollar sign just changes to before the row number. That just means the row is fixed. Again, if I press it, the dollar sign only appears before the column letter rather. And that just means that the column reference is fixed. So for the purposes of this, we want to fix the entire cell. We want to make sure this count reference does not move. And I can press enter here. And then I can copy the formula down as we've done previously by clicking the little green box on the selected cell and dragging that down appropriately. And then if we check the other cells, you'll see that they're referencing, the blue reference here has changed. So it's referencing the correct cell for negative data points and then dividing by the total count still because that cell has not moved because we fixed the references. And that is the same for zeros as well, our 0 data points. So finally, let's move on to frequency adjusted return. Another way of saying this is it's the probability adjusted return. It's just going to multiply our average returns for positive data points by the frequency or probability for those points occurring. So those positive data points occurring. So basically it's going to be cell L32 times cell N32. Let's type that in, equals, make a reference to L32 times, which is the star button on the keyboard, cell N32. And we get a value there. Remember, I'm going to be changing and formatting these values to percentages shortly, so they're a little bit more easily understandable, but let's continue with the formulas first. So in the next cell, we can just actually copy this formula down all the way to both negative data points and 0 data points. And then we get our probability adjusted returns. Okay, so at this stage, let's format some of these cells. So I'm going to format our average returns, our frequency, and our frequency adjusted return. They all need to be formatted as percentages. So I'm making the selection of those cells, right clicking within the selection, going to format cells, and then changing the category in the number tab to percentage to, we'll do 3 decimal places. And then I'm going to make a selection over here from cell N32 to O34 to take care of our frequency percentage and frequency adjusted returns. So right click within that selection, format cells, percentage to 3 decimal places is fine. And then we can see what's going on. So our positive data points have an average return of 0.683%. Our negative data points have an average return of minus 0.7%. However, we have more positive data points than negative data points, 52.8% versus 46.7%, and only 0.3% are 0 returns on the day, on the period. Now, our probability adjusted return is just what I said earlier. It's the frequency times the returns. And if you add those together, if you add all of those up, so a little trick here, by the way, is if you select some cells like this with some values in, you can see at the bottom, often it will come up with an average quick summary and a sum quick summary. So you can see that the average of these values I've selected is 0.011%. That's a little bit irrelevant to us, but the sum is 0.032%, and that sum is going to be exactly equal to the mean for the entire data set. So before we continue, let's tidy up this part of the spreadsheet. So this table that we've just created, we'll add some borders in and make the text bold. So I'm just going to make a selection over that entire table that we've just created from K31 to O34. I'm going to go to our border options in the Home tab and select all borders. I'm then going to do the same thing with that still selected and add some thick outside borders. And then I'm going to select all of our titles. So we've got negative data points, positive data points, and 0. I've got those cells selected and I'm going to make them bold. Remember, I can do this by clicking bold on the Home tab up here, or I can just press Ctrl B on the keyboard and it will make those cells bold. I'll do the same for these ones here. So that's cell L31 to O31. Our average returns, count, frequency percent, and frequency adjusted return titles. The final analysis table that we're going to build in this spreadsheet is going to tell us a little bit more about how our distribution of returns that we're analysing compares to that of a normal distribution. We're going to do that by counting the number of data points that lie within 1, 2, and 3 standard deviations from the mean, and see how that kind of compares with what a normal distribution would predict. So as before, I'm going to start by just creating the titles for each of the columns and rows in our data table. I'm going to start in cell K36, and I'm just going to type in std space DEV. That's going to stand for standard deviation because it's our standard deviation title. That's already made itself bold, which is useful, means we don't have to do it later. In the next cell in L36, I'm going to type in upper bound, and in column M, so M36, I'm going to put lower bound, and then actual count in cell N36, then actual count percentage in the next cell O36, and then finally in P36, I'll put normal percentage count. Let's select all of those titles that we've just made and make them bold with Control B. Moving on to the titles vertically, we're just going to put in below standard deviation in cell K37. We're going to put 1 in K38, 2, and then 3 in K39. We can make those bold as well if we wish. And you can see that the lower bound title is cut off here. So let's make sure we expand that column width by double clicking the intersection. That will make it a little bit wider, actually dragging it out, just so we make sure we've got enough space. Okay, let's move on to the calculations. So what we're going to do here is basically define some upper and lower bounds using 1, 2, and 3 standard deviations from our mean of the data set. And then we're going to count the number of data points that lie within those bounds and what that translates to as a percentage of the total count in our data set, and then also how that compares to the percentage that we'd expect to see in a normally distributed asset or just any normal distribution. So in cell L37, what I'm going to do now is create a formula which calculates the upper bound of 1 standard deviation from the mean of our dataset. Our dataset, of course, being our close-to-close returns in column G. So in that cell, L37, I'm going to type equals. I'm then going to reference our mean value in our descriptive statistics table and fix that reference with $ around the column and the row to make sure that doesn't move when we copy the formula down or across. I'm then going to add to that 1 standard deviation. And to do that, I'm going to put a plus sign and then open some brackets. I'm then going to reference the 1 in cell K37. I'm going to leave that dynamic, so I'm not going to fix the row or the column there. I'm then going to times that by the standard deviation. So that is cell reference L21, and we can fix that cell reference because we don't want that to move when we copy this formula down. And then finally, we can close the brackets and press enter. And don't worry about the formatting for this number. We'll figure that out after we've done some of the rest of the table. And we can copy this down to the cells below, and then we can check them. So we've still got the mean, which is fixed for 2 standard deviations from the mean. We're using the upper bound calculation of the mean plus 2 times the standard deviation, which is obviously 2 standard deviations above the mean, and a similar thing for 3 standard deviations above the mean. Let's use a similar method to calculate our lower bounds. So this time in cell M37, I'm going to type equals, make a reference to our mean cell reference, which was L17. Fix that reference. This time we're going to minus, in open brackets, 1 standard deviation. So minus open brackets, make the cell reference to 1, leave that dynamic, don't fix it, times by L21, which is our cell reference for standard deviation. We can fix this one. So this is basically taking the mean and then minusing 1 standard deviation from that mean. And that will be our lower bound. Again, we've got some formatting issues. Let's not worry too much about that just now. We'll fix that in a few moments. But first, what I want to do is move our attention to what we expect to see in 1, 2, and 3 standard deviations from the mean in a normal distribution. And if you refer back to your Introduction for Statistics PDF, you'll see that in a normally distributed data set, 68.27% of the data lies within 1 standard deviation from the mean. So I'm going to put 68.27% in this cell P37. And within 2 standard deviations from the mean in a normally distributed data set, we see 95.45% of the data. And finally, within 3 standard deviations, we typically see, or we do see, 99.73% of the data. So let's go back to these bounds now and format these correctly. I'm just going to select those cells from L37 to M39, right click within that selection, format those cells to percentages to 3 decimal places. And there we go, that makes a little bit more sense now. And the next stage is to compare what percentage of our data set lies within these bounds compared to what we'd expect to see in a normal distribution. The first thing we then want to do is basically count the number of occurrences or data points that occur within these bounds and then translate those values to a percentage count by dividing them by the total number of data points in the data set. So we start in cell N37 and the formula is going to be equals count ifs this time, so not count if, because we're going to count the number of data points in column G subject to more than 1 criteria because we've got both an upper bound and a lower bound. So this is how we're going to do that. We're going to put in equals count ifs open brackets. We're then going to choose a criteria range for our first criteria. The range is always going to be column G, which is our close to close returns. Then going to put in a comma and choose our first criteria. Now our first criteria is going to be greater than our lower bound, and the way we can do that is typing in quotation marks a greater than mathematical operator, kind of like we did before, except this time after the second quotation mark we're going to put an ampersand and then click on the lower bound cell reference M37. And what that's basically going to do is link the mathematical operator to that cell reference. And this is just a bit of a quirk in Excel. You just have to get used to a few things like this. This is just how it works if you want to use this kind of strategy in a count ifs formula. So to get greater than this cell, you link them like this with an ampersand. So let's move on to the next criteria, which will be less than our upper bound, but we need to choose our criteria range again. So we're going to reselect column G here, put in another comma, and then for our second criteria, we're going to put in quotation marks, less than this time, and then link that with an ampersand to our cell reference of L37, which is our upper bound. And then finally, we close the brackets for that function, and we can enter the formula, which returns us a count. So we can see that 11,734 data points lie within those bounds. And that compares to a total number of data points in the dataset of 14,822. So let's continue. We can copy this formula down to these other cells here. And we can see, we'll check these quickly, but we can see that it's using the COUNTIFs formula. For the first criteria, it's saying greater than the lower bound for 2 standard deviations from the mean. And for the second criteria, it's less than the upper bound for 2 standard deviations from the mean. That looks fine. Obviously, it's referencing column G for the criteria range as well. So those look good. And we can see that 14,130 data points lie within 2 standard deviations, and 14,613 lie within 3 standard deviations from the mean. So to compare that to what a normal distribution predicts, let's turn these counts into percentages by dividing them by the total number of data points. So in cell O37, I'm going to type equals, then make a reference to the actual count that we saw between these bounds for 1 standard deviation. So that's N37. And then divide that by the total count, which is L29. And I'm going to fix that reference so we can copy this formula down easily. Then press enter. And then I'll copy that formula down by clicking and dragging the little green box down to these other cells. And finally, I'll right click within that selection, format the cells as a percentage to 2 decimal places. And we can now compare these to what a normal distribution would predict. And actually, what you can see here is that the data matches what we would expect, given that earlier in our analysis, we saw the kurtosis and skewness values of 20.82 and minus 0.64. So essentially, when compared to a normal distribution, the actual distribution we have is peakier, meaning that there's more data points that lie within 1 standard deviation than we would predict with a normal distribution. And then the distribution actually narrows significantly, so that by the time you get to 2 standard deviations, the amount of data accounted for is actually slightly less than a normal distribution would predict. And that means that anything beyond 2 standard deviations means that it's got to make up that difference, and the tails are going to be fatter. Which in real terms basically means that the probability for extremes are higher than the normal distribution would predict. Why does this matter? Well, by comparing that data to a normal distribution, you've got a reference point in your mind for kind of analyzing returns of various assets over various timeframes. It's also important for those of you that might be looking to kind of trade in a more professional setting. Because what you'll see in that environment is that many of the quantitative models used use normal distributions as an assumption for the distribution of returns of many different assets. And the reason they kind of do that is because it's a very simple distribution to define. But you can tell just by doing this exercise here that the real empirical distributions of a lot of these assets are actually slightly different. And the higher probability of extremes are kind of significant importance when you handle these mathematical models. So just something of note that for you guys that might be kind of pursuing more of a professional setting in your trading, then you can be aware of that. So let's just finish off this table quickly by adding some borders. I'm just going to select from cell K36 to P39 and add borders, all borders for those cells, and then again with that selection still there, add thick outside borders, and that looks good now. So that's pretty much it in terms of teaching you guys how to build one of these distribution of returns analysis sheets from scratch. But now we've done that, what else can we conclude about the data that we see here? So we're looking at daily returns for the S&P 500, and we can see that on average, we have a mean return, close-to-close return of around 0.03%, and that around 80% of the time, the index moves less than roughly 1% either side of the mean. And that should basically reinforce the points that Anton made in the previous video, that you need to be smart when you choose both the time frame and the assets that you trade to make sure that they offer you enough opportunity to make profit. Remember that, the market dictates where volatility is, and hence the risk and opportunity lies, not you, not your broker, and obviously not a charlatan educator either. If you learn to widen your time horizon and look for assets with higher volatility, then you're going to increase the risk, but also importantly, you're going to increase your opportunity as well. Now, I'm not going to spend any more time building out this sheet with high to low returns and open to close returns distributions, as the steps that we would go through are largely identical to the ones that we've already covered in this practical. And you can just use that, as an exercise yourselves to practice the process and, continually improve your competency in this area. And I do think it is important that you build a sheet like this yourselves to practice the skills that you've learned. But what I also want to show you now is some templates that you can use to speed up this whole analysis. And you're going to have access to these templates in the download section, so you don't have to worry about building them yourselves. And so I think we'll head over to the template spreadsheet now to see how that works. So this is the template file that you guys are going to have available to you in the downloads area. And essentially this file's split into 5 different sheets. 4 are templates, so daily, weekly, monthly, and quarterly returns templates. And 1 sheet is a summary table as well, which we're going to look at later. Now, all of the template sheets, so the daily, weekly, monthly, and quarterly templates, have S&P 500 prices within them to begin with, and I'm going to show you how they will work shortly. But before I do, let me just continue where I left off a little bit previously in the video with a touch more analysis on daily S&P 500 returns. So in that last section of the video, we analysed close-to-close returns for adjusted close prices from Yahoo Finance, but I stopped short of building out the data tables and charts for open-to-close and high-to-low returns because the process is very similar, and like I said, it's good practice for you guys to have a go at doing that yourselves. But what I want to do now is briefly take you through a few quick points on analysing those returns once they're built out, because they're already built out in this first daily template sheet. So our open to close daily returns are use intraday data. So intuitively, we would expect the prices to fluctuate less because effectively the time horizon is slightly shorter, given there's no out of hours market price movements. And we can see here, if we compare the descriptive statistics for the open to close returns to the close to close returns, that the mean return is lower and also the standard deviation is lower. So the volatility is lower for intraday price movements. And the conclusions that we reach with all of this data that we've got in the open to close daily returns section are very similar in general to that which we came for the close to close returns. But I just wanted to point out that there's even less volatility when you're just trading intraday, as opposed to even close to close daily prices. Let's cast our eye over to the high to low return section now. And these need to be treated slightly differently because structurally, all the data points or returns are capped on the lower end at 0, and that skews the distribution significantly. So this is nothing like normal because you cannot get a high to low return that is less than 0. Obviously, the high is always going to be greater than the low. And what these returns kind of imply is that you can perfectly time the market every period by buying at the low and selling at the high. And obviously that's completely unrealistic. So why do we even kind of pay attention to this high to low data? Well, it's kind of just another way of understanding the volatility in the asset. In this case, we're assessing what the maximum possible return is on an average day. So that's the mean here in this cell. And in this case, even if we disregard that obtaining maximum returns isn't possible, then we still see that the returns on a short time horizon, like daily, intraday returns here, high to low returns, are not really very high. And that points us yet again to extending the time horizon that we trade over and picking assets that provide more volatility and with it, of course, risk, but also opportunity for profit. So how do these templates actually speed up your work? Well, all the analysis components of these spreadsheets are driven by Excel formulas that don't need to be changed. So all you need to do is effectively dump in some new price data into the first few columns, and everything else in these sheets, so long as the data has been cleaned and manipulated properly before you dump the data in, everything else is going to update automatically and correctly. Basically, the way that that's done is in a lot of the cells where before we use things like analysis toolpack or just typed in values, they're instead all driven by formulas which update automatically from these first few columns of data that you put in. So we've got new formulas and functions in the descriptive statistics table and in this frequency table at the top as well. Particularly the intervals and bins are interesting, which I'll go through shortly. It's not necessary that you get to know all of these formulas and how they work, but it will improve your Excel skills immeasurably, and it will help you build your own custom analysis spreadsheets in the future. So I am going to do my best now to go through these briefly, just so that you have an idea of how they work. So let's start with the descriptive statistics and the mean. So remember, our descriptive statistics table was previously just generated by using the data analysis tool, but we can actually just type all of these descriptive statistics titles in and then calculate the relevant value for them. So that's what I've done here. So in column L, down these values, I'll just go through them quickly. The mean is just the average of column G. In this circumstance, obviously, when you're looking at high to low returns and open to close, they need to change the reference. So high to low returns reference column H and open to close will reference column I. That's the case for all of these references. And don't be shy, when you have these templates, look through all of the cells and the formulas to see how this all works. That's how you really generate a really good understanding of Excel and how to use it as a powerful tool for your analysis when it comes to trading. Anyway, let's get back to this. Standard error, we don't need to worry about too much, but you can have a look at that formula in your own time if you want to. The median is simply the median, and then we reference the returns in column G. Same with the mode. Standard deviation is also the same. There's a couple of different functions for standard deviation, but .s is the one that you should use, stdev.s. That's the sample standard deviation. Variance as well, var.s, and we are always referencing column G, or the returns column that we want. Kurtosis is just Kurt, and then referencing that same column. Skew, same, skew, and referencing the column. The range we can just take by taking the difference between the minimum and the maximum. That's easy enough. And then there is a min function for finding the minimum in a set of cells. So we're just typing min, open brackets, referencing column G. The same for maximum. The function is max. And the same for sum as well. And count. So all of those are actually really easy. So long as you know the functions to use, all you have to do is enter that function and then basically reference the data set that you're looking for. So in this case, for close to close returns, that's going to be column G, our close to close returns in column G. And like I said before, make sure you change the references when it comes to high to low or open to close. You won't actually need to do this because you can just use the template. But if you want to kind of reverse engineer it, then that's how you would do it. So let's go over to our frequency table now, and I'm going to start with intervals here. You'll remember from the previous part of the video that we typed in the intervals kind of manually, and we were kind of shooting in the dark in terms of needing to know what the volatility of the asset was before we created the intervals, so that we created intervals that kind of worked effectively for our data. You do obviously get better at doing that with lots of different analysis of lots of different assets by doing it the way we looked at previously. But in this template, I've kind of used a bit of a shortcut whereby I'm creating intervals that always adjust to 3 standard deviations above and below the mean. And I've done that in these cells here. So for example, the smallest interval is referencing the mean minus 3 times the standard deviation, and the largest interval is the mean plus 3 times the standard deviation, and everything in between is a stepwise change of the same value upwards. So that's how you can kind of cheat your way through creating intervals that work for this analysis. And your bin range, is just the same as intervals. So I've just created a reference that makes those bin cells equal to the intervals. If we move on to frequency, then this is just using that count method that we used down in this part of the analysis in the previous part of the video. So these count formulas are count if column G is less than or equal to a certain criteria. So the first range that we're looking at is less than this interval. So what I'm doing is counting if, referencing the range that we want to conduct the count within. And then the criteria is within quotation marks less than or equal to ampersand, because remember we need an ampersand to link that operator to a cell reference, and we're referencing this interval rather than typing it in, because this interval will change depending on the data that we put in the first few columns. So cell references are everywhere in these formulas, and that's just so that everything stays automated. If we look at another one just briefly, we'll see that I need to use the count ifs formula for a lot of these because we've got 2 criteria. We're counting between 2 bounds, a bit like we did down here in our previous analysis, but we're counting between 2 intervals instead. So I'm going less than or equal to this value, but greater than and equal to the purple cell here. So that keeps everything automated and updating automatically. Let's look at the range values quickly. So the way this formula works is we put in quotation marks some text and we link that to a function with an ampersand. We kind of used to this way of operating, way that Excel operates by now. So we've basically got in the first range equals, and then in quotation marks less than, space, close the quotation marks, that's the text. Then we're going to link that with an ampersand to a function. The function is called text. And then after a function, we always have open brackets with several different parameters. And the first parameter is the value that we want to turn into text. So the cell reference is the interval. And the format that we want the text is the kind of percentage format to 2 decimal places within quotation marks. So that is the way that you turn a number in a cell reference into a certain text format. And you can see what the result is there, less than minus 3.07%. And you can go through these other ones and check them yourselves to see how they all work. So I've told you how the template works. Let's now put that into action by pulling in some other different data into one of these sheets. But before we begin, the one thing that I want you to be careful of with these templates is just making sure that you set up your data set in the first few columns correctly. And depending on where you're pulling the data from, they might not have the same data availability as we've looked at in Yahoo Finance, or the columns might be ordered differently. And if that's the case, we're going to have to order things correctly and rearrange the data first, and potentially go through some manipulations of the data as well. And there's also a couple of other checks that we'd want to make sure we do before and after we input the new data into the template as well. But let's just get stuck in, and I'll explain some of them as we go. So what we're going to do now is replace this S&P 500 daily data with US dollar, Japanese yen currency data. You can find price data for different assets on a number of websites, whether they're kind of free or paid for. But something you need to be aware of is that they can always be subject to change. So the reason that I'm pointing this out is because although these templates are set up to handle Yahoo Finance data, you may need to use data from a different source in the future, or if you can't find the data that you're looking for on Yahoo Finance. And when that happens, you'll need to make sure you understand what manipulations need to be made to the data and any rearranging of that underlying data as well before you dump it into the spreadsheet. So to illustrate that, I'm going to use USD JPY currency data from investing.com. And you'll need to register to the website to be able to get hold of the data for free. So you can just do that yourselves. I'm not going to go through that aspect. But once you are registered and logged in, all you have to do is search in the top search bar for USD JPY currency pair. And when you type that in, you'll be able to find it easily from the drop-down menu there. And you can click on that and that will take you to a kind of USD JPY currency pair homepage. And then kind of similarly to Yahoo Finance, we just navigate to the historical data tab of this page and you can see all the historical data there. And again, similarly to Yahoo Finance, we've got two variables that we can change. One is the time frame, whether it's daily, weekly, or monthly. We're going to leave that as daily because we're going to replace the daily S&P prices with this currency pair. And also the period, the time horizon that you're kind of obtaining or retrieving all these data points back to. Now, a little quirk of investing.com that I've found is that it only seems to contain about the last 19 years or so of daily data for some reason. So what I'm going to do here is click on this date range and change the year in the start date to 2001. I'll just leave the date and the month that were already in there and today's date in the end date as well. I'm just going to click apply. And then we can do a quick scroll if we want down the page just to check that it's got all that data, but I'm sure it has. Yeah. And what we can do from there is then download the data into Excel format. Again, very similarly to how we did that with Yahoo Finance. We just click this download data button here. And like I explained before, it's going to download this in a CSV format. That'll open into Excel. Where this is stored on your computer is down to your operating system and web browser and so on. But for me with Google Chrome, I can just open this from this quick shortcut link here. And once I do that, you'll see that I've got all of the data that I need from investing.com for the USD JPY currency pair. So let me now point out a couple of quick differences that we can see between this data and the kind of data that we would download from Yahoo Finance. So in Yahoo Finance, you'll remember that we had an open, high, low, close, adjusted close, then volume. So we didn't have this percentage change column and we didn't have a price column, or the price column we actually did have, we just take that as the close. So we can kind of rename this column to close if we want, and that's in a different order because before we would have had close towards the end or towards the right-hand side of the data set. And we've got no adjusted close. Now, we wouldn't expect an adjusted close to be significant, of course, with a currency pair because there's no splits or dividends, but this would be the same if you downloaded some data for another asset as well, I believe. So the last thing to kind of notice with the differences of this data to Yahoo Finance data is, although we have dates in column A, they're not stored as dates in Excel, and that kind of doesn't matter for the analysis that we're going through here, but it's just something to be aware of. It could cause some problems in other spreadsheets that you create and so on. So I think in terms of rearranging this data, all we need to do here is select column B, which is the price column. And if you then put your cursor towards the edge of the selection, say the right-hand edge, and then right-click with your mouse and drag over into column F, so past column E, and then let go, it will give you an option here to shift right and move that column. That's just a really quick way of moving that whole column to the right-hand side by that many columns and shifting everything else appropriately. So I'll left-click, shift, right, and move now, and you'll see what's happened. It's basically swapped the position of the price column from column B to column E and shifted the other 3 across to the left by 1 column each. So now we've got a similar order to what we would have seen in Yahoo Finance. We can assume this is open, high, low, and close. And we don't have adjusted close or volume, of course. There's no worries with that because we don't need it for this analysis. Let's go back to the template sheet quickly and just remind ourselves of the setup of the data that we require. So date in column A, open in B, high in C, low in D, and close in E. That's fine. We're kind of set up for that with the data that we have already. The adjusted close we're going to tackle shortly. But for now, what I want to do is make sure that you know that you should delete all the data in these columns. So from column A to F, from row 2 down right to the bottom of the end of the data set, basically. So we can select all those cells from A2 to F2 and press Control Shift and down. That will make sure we go right to the end of the data set. And then we're just going to press delete. You'll see once we do that all the calculations in the rest of the worksheet return errors. Okay, that's expected because we've got no underlying data to work with. Okay, so at this stage, we're ready to input our new data. To do that, let's go back to the data that we downloaded in this file. And what we're going to do is select from cell A2 to E2 and press Control Shift and down to select all of that data in those columns down to the end of the data set, and then press Control C to copy on your keyboard, or if you prefer, you can copy using your mouse right-clicking within the selection and just clicking copy at the top of these options here. So I prefer to use the keyboard, Control C for this shortcut. Then we'll go back to our template and paste this into A2. So again, you can click into cell A2 in the template. Remember to make sure as well, obviously at this stage, is that we downloaded daily data. So make sure you use the daily template when you're pasting the data in. So we can right click and paste, or we can just select cell A2 and press Control V, which is a paste shortcut. And then Excel is going to run a lot of calculations, which is why it's being a bit slow, because it's doing all of these spreadsheet calculations for all of this data that we've just dumped in. So we'll probably have to wait a few moments for that. Okay, there we go. I'm going to very quickly expand column A so we can see all the dates. Remember, we do that by left clicking the intersection of that column and dragging it outwards or dragging it right. And let's see what we have. So we can see straight away that we've got a load of errors in our close to close returns. Now that's fairly obvious. Why that's happening is because it's trying to reference the adjusted close column, which has no prices in. And we can tackle that really easily by just copying all our close data into the adjusted close column. So what I'm going to do here is select cell E2, Control Shift and down on the keyboard, Control C to copy all of that data, go back to the top of the spreadsheet, and then in cell F2, just paste it in. So I'm going to use Control V to paste all of that data in. Again, Excel's going to take a few moments to run all these calculations, but then we should stop seeing the majority of our error cells. Okay, so we've still got quite a few errors actually, and this is good because this is something that I wanted to point out to you guys next. We aren't done at this stage once we've just dumped the data in. We've got to make sure that these calculation columns, G, H, and I, are working correctly as well, because remember, before we copied these formulas down as far as the dataset went for the S&P 500. So this dataset might be shorter, it might be longer. We've got to make sure that all the returns are kind of working across the entire data set. So let's go down to the bottom of this column F and see what's happening here. So you can see that our calculations in columns G, H, and I were running a lot further down the spreadsheet previously when we had S&P 500 data, because it was going back a lot further in history than back to 2001. I think it went back around 22,000 cells, and this is going back around 5,000 cells. So each time you dump new data in, you need to make these checks. You need to go and check that the calculation cells run as long as the data set runs. So in this case, we've got a shorter data set. So what we do is delete basically all of these error cells here. So we just click on this one, for example, G4980, and delete, or right click within it and clear contents. Every time we delete a single cell, it's going to take ages in Excel. Don't worry, the next time we do this, we're going to be deleting all of them at once, all of these error cells at once. So now if I select all of them from 4981 and press, so that's GH&I 4981, and then Control Shift and down on the keyboard to select the end of the data set. Notice here as well, quick thing, that when I press Control Shift and down here, it selects towards the end of the data set for the first column that was selected. So actually, we've still got 2 extra values that we need to make sure that we delete below. We can actually add them into the current selection by just holding Shift on its own and pressing down once on the keyboard. That will add in an extra row. With all of those selected, we can press Delete on the keyboard. And again, Excel's going to update, take a little while to calculate. And now we've cleaned the data set. All of the calculation cells above should be working properly. One thing I want to point out just briefly before we have a look at those values is that if you were to have a longer data set than the one you already have in your template, so if you're replacing a shorter data set with a longer data set, then all you'll be doing here is, for example, let me just delete these calculation cells here, actually. All you'll be doing is you'll be faced with something like this, where the prices go on longer than the calculations. So you just need to drag these calculations down to the end of the spreadsheet. And remember, for close to close returns, we drag it to the end -1 because it always needs to reference a cell that is prior, let's say like a prior ending price, a previous period's ending price. So I'm just going to copy these down now. These are just little things that, are going to affect the way that you use the spreadsheet. They don't take much to get over, but I just want to make sure all bases are covered by going through some of this stuff. So back to the top of the spreadsheet. And we can see now that all the calculations across our close to close daily returns, high to low daily returns, and open to close daily returns sections are looking good, and we can just analyze those as we wish. So let's just do a very brief overview of a couple of these values. So from here, like I said, you can interpret these results once the calculations have actually run. And we can see with these results, for example, that the mean is even closer to 0 for this currency pair than the S&P 500 daily returns were. And the standard deviation is also even less from close to close. And we can kind of make a very quick conclusion that this asset is even less volatile than the one we had in previously, which was the S&P 500. So let's now look at the other end of the scale, a different asset that's going to be more volatile. So say a mid-cap equity, perhaps Freshpet, FRPT, and we'll get the daily data from Yahoo Finance this time. And it's worth pointing out actually that we could have obtained the previous currency data from Yahoo Finance as well, actually, but I wanted to teach you guys how you can still use the template despite getting the data from anywhere, as long as you know how the template works and you can kind of manipulate and rearrange the data as necessary. So let's head over to Yahoo Finance. And within the search bar at the top of the page, this time we'll be putting in FRPT. And we'll click Freshpet from the drop-down. And once we're in the homepage for Freshpet, we'll go to the historical data tab as we did before for the S&P 500. Click the maximum time period. We're going to stick with a daily frequency at the moment, click apply, and then I'm going to download the data. I'll open that sheet, rearrange the first column's width so we can see those dates. Remember, this is in the dates are in ascending order, not descending order by default for Yahoo Finance. So let's switch those around. Remember to do that, we go to data on the ribbon, then filter, then we'll select the drop down arrow in the date column, and then we'll just sort that from newest to oldest, and then we can remove the filter by clicking the filter button again. And from there, we can just copy this data straight into our template spreadsheet, our daily template spreadsheet. So I'm going to select from cell A2 to F2, Control Shift and down to select the data all the way to the bottom of the FRPT daily dataset from Yahoo Finance. Once I've copied that selection with Control C, I'm going to then go back to our daily template and paste that into cell A2, just like I did before, except this time we've actually got the appropriate columns straight away for the template because we're getting the data from Yahoo Finance, which is just the open, high, low, close, and adjusted close. So we didn't really need to do any manipulations or rearranging of the data. And now that we've pasted all of that data in, obviously Excel is going to be calculating for a few moments and automatically updating all the data here. Now, it may look like we've got all of our calculations running correctly because you can see that all of this analysis actually looks okay. But remember, we always need to check what's happening throughout the data set. So let's go to the end of column F, and we can see that actually we forgot to delete the data that we had in previously. And this is a really good example of what happens when you forget to do that, or what can happen. So we're using old stale data from the USD JPY currency pair mixed in with our FRPT Yahoo Finance data, which is why actually we've got some really low values for our kind of volatility and so on. So let's try that again. Let's fix it by deleting all of the data. Remember, you need to delete all the data in columns A to F from row 2 downwards first. So we're going to delete all of that data in the template. Then we're going to go back to our FRPT data file, copy all of that selection and paste it back into our template. So we can right click in cell A2 and just paste as values. So that's this clipboard with the 1, 2, 3 here. Or you can just press Control V, either works. So again, this is going to take a few moments to calculate. Okay, there we go. This time we've got a load of errors in our analysis. That's fine. We semi-expect that whenever we paste in new data because we need to make sure that our calculation columns are matched up with the length of our data set. So let's go to the end of the data set again. And you'll see that we've got the same problem as previously we had with USD JPY currency pair, in that we're pasting a shorter data set over a longer data set. So all the calculations are still running a lot further than they should. We can easily fix that by deleting all of these error cells here. So I'm just going to delete this one first and then go down, select all of these cells, all of these errors, and delete all of those as well. And once I've done that, we should be able to analyze this asset very quickly. So you can see how much faster this is, especially once you get used to just manipulating this data quickly, how much faster this is to analyze volatility across loads of different assets and different timeframes by using these templates. So just by looking at some of the data here, the descriptive statistics, the standard deviation value for our close to close returns, we can look at the mean for our high to low returns. All of this data very quickly and obviously says to us that this asset is much more volatile than the ones we looked at previously. And therefore there is more risk in trading it, but also more opportunity to make profit than trading, for example, a large cap equity index or a major currency pair. I also want to point out that as well as that, this doesn't mean that we kind of should be trading this asset. I am just using this FRPT mid-cap equity as an example to show the difference in volatility between different kinds of assets. All we're doing here is just picking a random mid-cap stock to kind of show those differences between mid-cap stocks, equity indices, and currency pairs in terms of their volatility and hence opportunity. And remember, as Anton said in the previous video, you'll find that volatility is higher in equities as an asset class compared to bonds and currencies. And also, it gets higher as we slide down the market cap scale. So lower market cap companies, smaller companies generally are more volatile, which makes sense because they typically have more volatile and less established revenue streams, and they haven't matured into a large, diverse corporation as many of the large and mega caps have. So on a daily basis, we can say that, we've got around 80% of the data lies within one standard deviation from the mean. So we know that it's peaky as well, like our other data that we looked at, our other assets. But we can say something that is different about this compared to previous assets, which is, our standard deviation is a lot larger, it's a lot bigger. So that means the volatility is a lot higher. And we can see that there's a much higher probability of return ranges on any given day being a lot wider, so either a lot more negative or a lot more positive than the previous assets that we looked at. So it's fairly clear, from our standard deviation of close to close returns and standard deviation of open to close daily returns, and of course our mean high to low daily returns for this asset, that it is a lot more volatile. Let's now see kind of how that changes with time horizon rather than across assets. So let's have a look at quarterly returns for FRPT Fresh Pair. So I'm going to go back to Yahoo Finance and change the frequency here. And you're actually going to notice that there isn't a quarterly frequency available. So we're going to have to use a few tricks in order to change our monthly data to quarterly data, and I'll show you how to do that just now. So to start with, we'll change the frequency to monthly. We want to make sure we're still getting the maximum time period possible of data from Yahoo Finance for this asset. Click apply and then download. And now that we've got this monthly data in a file in Excel, open in Excel, let's expand the date column and make the change that we always make first with Yahoo Finance data, which is sorting the dates into a descending order. So I'm just going to select cell A1, go to data, go to filter, select the filter option within cell A1 and then sort from newest to oldest, and then click on the filter option again in the ribbon to get rid of that filter. Something to notice here is that with Yahoo Finance data, it's always going to try and show you the latest data possible, which actually in this case we want to delete because it doesn't account for the whole month. So you can see we've got a date of the 18th of November here, but all the monthly data going back before that is taken from the first of each month. So we should delete this row 2 with that price data on the 18th of November. You can do that by right clicking on the 2 at the left hand side, so row number 2, and then just going to delete. Now what we need to do is worry about how we get these monthly returns to quarterly returns. And what we're going to try and do is basically just take every third month from these rows and just keep that data and delete the rest. But if we do that with no adjustments first, we're not going to get the right values for our high column and our low column, because it's just going to take the high and low of that month, not that quarter. So what I'm going to do in column H is head this column with high again and column I with low. So that's in cells H1 and I1 appropriately. And then in cell H2, what I'm going to do is type equals max So this is the max function, open brackets, and then select the last 3 months that correspond to that cell. So basically, for the 1st of November 2020, we're taking the max high from the previous 3 months, or the previous 2 months and the current month. And we'll close brackets there, and then copy that formula down. And we're going to do a similar thing for the low. So in cell I2, I'm going to type equals min, open brackets, and then select the 3 low prices from cells D2 to D4. And then just copy that formula down. So just to reiterate, what we're doing here is just making sure that our high is the high of the last 3 months and our low is the low of the last 3 months. And that means when we start deleting some months, we kind of translated our monthly highs into quarterly highs and our monthly lows into quarterly lows. If we were going to look at open to close prices, close returns rather, as well for quarterly returns, we would also need to figure out how we're going to change the open value as well. But for weekly, monthly and quarterly returns, we only consider the close to close and the high to low returns. So we don't need to worry too much about that. So from here, we want to overwrite the values that we have in columns C and D for high and low with these new values that we have in column H and I. So I'm going to select cells H and I2 and then press Control Shift and down to highlight all of those values that we've calculated in those columns. And then I'm going to click on cell C2 and we're going to paste them. This time we cannot use Control V to paste them, because that will paste the formulas across these columns, and we want to make sure we paste these as values so they're not subject to change. So in cell C2, I'm going to right click within that cell and paste as values, which is the clipboard saying 1, 2, 3 on it. And that's going to paste these as values into the high and low columns C and D. We can then delete column H and I. We don't need that anymore. So the next step is to change our monthly data to quarterly data, and we're going to do that by deleting 2 out of every 3 months in our date column. And to do that, I'm going to insert a new column A. So I'm going to right click on column A up here and click on insert. That's going to put a new column before the date column. And in cell A2, I'm going to type equals month and then reference B2. So basically what this function does is return the number of the month. So for example, 1 would be January and 12 would be December for the date that it's referencing. Press enter there. You can see that on the 1st of November 2020, the month that it pulls back from that is November, the 11th month. So I'm going to copy that formula all the way down to the bottom of the sheet by just double clicking the little green box in the bottom right of the cell. And then I'm going to click into cell A1, a blank cell, and go to filter on the ribbon and choose this filter option in column A. So in cell A1, I'm going to click on the filter drop down menu there. And what we're going to do is basically deselect all of the numbers, because you can see you can filter all of these rows by these numbers 1 to 12. So that basically acts as our months. And we're only going to select the sort of 2 months of each quarter that we want to delete. So let's say we're starting with a November price. We want to delete both October and September. Then we skip a number because we want the August price. We delete July and June. We keep the May price. We delete March and April, and so on. We keep the February price and delete January and actually December as well. So if I press OK here, what you'll see is it's returned just all of those prices for the rows that we want to delete. So you can see on the left-hand side that the row numbers now look a little bit sporadic. It goes 1, 3, 4, 6, 7, 9, so on. It's not completely sequential. That's because it's filtered out the data that we want to keep. So all of these rows, if I go from row 3, left click on row 3 here, and press Control Shift and down to the end of the data set, that'll select all the rows to the end of the data set that is showing with this filter on. And I can right click within that selection and just left click on delete row, and all of that data will disappear. And then I can take off the filter, and all I'm left with is quarterly price data for that asset. So there we've turned monthly prices to quarterly prices and made sure, we keep the correct high and low. And like I said, don't worry that the open won't actually be correct if you're doing an open to close return. But for weekly, monthly and quarterly prices, we don't do an open to close return anyway. So no worries about that. So let's go back to our template. And in the quarterly template, we want to make sure that we delete all the data that we have in here previously. So I'm going to select from cell A2 to F2. And then press Control Shift and down to select all of the data to the end of the data set, and then press delete on the keyboard. You can of course right click within that selection and click on clear contents. You can see that the analysis sheet returns a lot of errors. That's what we expect because we don't have price data in there anymore, but the sheet is ready for us to put in this quarterly data that we've got here. So when we go back to this quarterly data, just make sure that you're copying from cell B2 because we don't need these numbers that we created in the first column. So copy from cell B2 to G26, and you can copy that with Control C, go back into the quarterly template and just paste that with Control V, or right click and paste as values if you like into that sheet. Remember then, of course, to adjust your calculation columns. Notice that we only have 2 calculation columns to deal with in a quarterly sheet. Remember, that's because we don't deal with open to close returns when we're looking at weekly, monthly or quarterly data. We need to adjust these calculation columns so we can just delete these errors as we've done previously. Just make sure you get all of them, and then we should get the correct analysis coming back to us. One thing that I want to quickly point out is if you do get errors, it probably is going to be because you haven't cleaned or manipulated the data correctly. So back to this example. It's not the best example to use in terms of robust statistical conclusions because the amount of data here that we have just isn't very much. We don't have that many quarters of data for this asset. But despite that, it still does show us that volatility in this asset, FRPT, Freshpet, is far greater than what we saw on a daily time horizon for the same asset, and of course much, much, much larger than our equity index that we looked at and a USD currency pair. So this is kind of just another reinforcement of the conclusions that we've been drilling into throughout this video and the previous one, which is, as you look through different assets, they're going to have varying levels of volatility. Some are going to be more volatile than others, and typically with that volatility comes risk and some opportunity for profit as well. And as you expand your trading time horizons, you'll also be able to take advantage of some more volatility and hence opportunity as well. So don't get stuck in the rut of day trading. That is one of the biggest downfalls that we see in retail traders, is that they think they can day trade when the volatility just isn't there to do so, especially in the assets they're looking at, because they tend to look at equity indices and currencies as well. So just to put some quick numbers on this, we could look down at our standard deviation table down here and see quite quickly that 70% of the data lands between the upper bound of plus 35% on a quarterly basis and minus 12% on a quarterly basis. That volatility is obviously much, much, much higher than the volatility for the same asset on a daily basis, where 70 to 80% of the data landed between plus 3 and minus 3%. So that's just an illustration with numbers of what happens when you increase the time horizon of your trades as well. You can, of course, see a similar conclusion in something like the mean high to low quarterly returns, which in this case is 50%. And you compare that to the daily value of 4%. And of course, that's much bigger even still than the equity indices and the currency pair that we looked at. So we've dealt with the daily template, the quarterly template. I'm not going to go through the weekly or monthly template because they act in a very similar manner to the quarterly one. So you'll be able to use all of these templates now. So let's turn our attention to the final aspect of this video, which is showing you guys how you can create your own summary table. So you will have seen volatility summary tables from the previous video that Anton showed you, and basically they help you to visualize volatility across the market in different assets and asset classes. What I've got here is just an initial setup of a summary table that you could build yourself. And let's say that you've got a list of different assets that you want to analyze volatility for. You've classified them into broad groups. So that's what I've written down in column D and E here. And note that obviously when you do this yourself, you may have different assets that you look at and you may classify things differently to what I've done here. It's just an example so that you can try and build something like this yourselves. You will then want to set up table headings for the time horizons that you want to look at and the type of volatility that you want to look at, whether it's close to close standard deviations or high to low return averages or whatever you want to look at. And from there, quite simply, you'll just go through the processes that I've taught over the course of this video to obtain values for each asset, for each of these time frames and volatility types. So for example, we could go to each of our templates. So let's say the daily template. At the moment, we've got FRPT daily returns in here. We could take the close to close standard deviation cell, that is cell L21, copy that into our summary table in the right place. So in the daily column for close to close standard deviation, in the FRPT row, and just right click within that cell and paste as a value. We could then do the same thing for our high to low average returns within that page. Copy that cell, paste it in the summary table in the correct place. So we're still looking at FRPT daily, but this time high to low average return. Again, I'll do another example. In the weekly file, we're just looking at S&P 500 returns. So I could put in the daily standard deviation close to close on a weekly basis for S&P 500. That would be in this cell here, paste it in as values. The same for the mean high to low weekly returns. Copy that cell, paste it into the high to low return average cell, weekly average cell for that asset. So we right click in the cell, paste as values. And once you've got all of those values in there, you can obviously format all of these cells, right click within them after you've selected them, go to format cells and just format them as a percentage to 2 or 3 decimal places like that. And once you've done that, you should have something that looks like this. And then what you might want to do after that is start trying to understand how all of these volatility values change by asset class. So at the moment, they're all listed individually, but we could average them by their group. For example, we could work out the average close to close standard deviation on a daily basis for all the currency major pairs and for all the equity indices, and we could compare them and see how volatility changes across various asset classes. Okay, so now let's create a separate table that summarizes the volatilities that we see across all of these assets and summarizes them by the asset class that they're in. So I'm going to make some titles for the table first. So in cell 04, I'm just going to put our first asset class that we're going to look at, which is FX major. I'm going to make sure that what I type in these cells matches the different asset classes that we see in column E here. So the first one's FX major, and then if I keep going down these cells in column O sequentially, I would then put in FXEM, standing for emerging market currencies, then equity index, then equity large cap, and then equity mid cap. I'll adjust that column width so it fits all of those text values in there. And then we want to create some titles for the volatility that we're actually going to assess. So in this table, I'm just going to look at close to close standard deviations for the 4 time frames that we have available, the 4 frequencies, which is daily, weekly, monthly, and quarterly. A really easy way to title this new table would just be to copy the titles from our table over here that lists all the assets. So to do that, I can just copy cell F2 across to P2, and then cells F3 to I3 across to P3 to S3. Obviously, those titles are in bold, so we should probably make these titles in column O bold as well. We can do that by selecting O4 to O8 and pressing Ctrl B. Now, you don't necessarily have to follow along with this example. I'm just trying to teach you what you can achieve in terms of creating your own summary table. You should get some ideas from what we're doing here in this practical demonstration, but also from the download files that you receive in this video and the previous one as well. So I just want to expand the column widths of these columns as well, just slightly, P through S. I'm going to select all of those columns and just click and drag slightly at one of the intersections to make them all a little bit wider. And now all we need to do is update this table with formulas that get hold of the average volatility or close to close standard deviation values for each of these asset classes across each of these time frames. And there's several ways you can do this. For example, for the FX major asset class, we could just sum up all the FX major values in daily close to close standard deviation and divide that by 4 and put that in this cell. But that's not a very automated way of doing things, so I'm going to show you what I think is the best way to formula drive this table so that you never need to touch it after you've set it up once, but you can keep adding assets underneath to this core table on the left-hand side, as long as you reference things properly and make sure you put in the right text value for your asset class column in column E. So you'll kind of see how that works in a minute. In cell P4, let's get started with this formula. I'm going to put equals average if, open brackets. The range I'm then going to reference is column E, that is the asset class range. I'm going to do that by clicking on the E at the top. And I want to fix that value. So fix that range, so I'm going to put $signs around that. Then if I put in a comma, I'll go into the criteria parameter of this function. And the criteria that we want to set is that we're calculating the average if the asset class is whatever is in this cell to the left, so O4, so in this case FX major. The way we do that is just put in that cell reference directly, so we can click on O4 and that will set the criteria to that asset class, so FX major. And for this reference, cell reference, we want to make it slightly dynamic, so dynamic up and down, but not be able to move across when we copy the formula. So I'm going to tap F4 3 times. That's going to put a $sign before the O, which fixes the column reference, but not the row reference. So we're going to be able to, when we drag this formula down and across, the only way that this cell reference can change is up and down. So along these 5 asset classes we've got here. Now we put in another comma and we need to pick the average range for this function. So this is just going to be column F, which is the daily close to close standard deviation, because we are in the daily close to close standard deviation cell within this table over here. And we don't need to fix that reference at all. We actually want it to move because we want it to move across weekly, monthly, and quarterly when we copy this formula across. So then I'm going to close the brackets. you'll see we've got a value there. So that's our average daily close-to-close standard deviation for that asset class. I can then copy that formula across, and it will fill in the average weekly, monthly, and quarterly close-to-close standard deviations for that asset class as well. We could click into average just to click into weekly just to check that. So you can see it's still averaging the column G now. So it's changed to column F to column G because we're looking at weekly standard deviations. And that's subject to the range, so column E, the asset class, being equal to 0.4. So that clearly still works. We can also copy all these formulas down. So if I select all of those cells, P4 to S4, and then click and drag the little green box on the bottom right of the selection all the way down to fill in the rest of our table, then we've now got values for every asset class across every interval when we're looking at close-to-close standard deviations. We'll just check one randomly to see if our formulas are working properly. So we're looking at equity large caps, a monthly standard deviation. What have we got here? The average range is column H, that's monthly standard deviations, that's correct. And it's averaging those subject to column E being equal to large cap equity. So that is correct as well. We could prove this to ourselves if you want, just by adding some of these up and dividing by the appropriate number. So if we wanted to check, for example, quarterly FX major standard deviation value, we could put in cell U4 here equals to the sum, open brackets, of these quarterly FX major values for these 4 assets divided by 4, and we'll get exactly the same value as we do in S4. So we know that all works. I'm not going to go on and do the same for our high to low return averages, because using the concepts that you've learned here for this first table, you can easily do that yourselves. What I am going to do instead is just make some final formatting changes to these tables. So I'm going to select cells P4 through to S8, right click within that selection, format those cells to a percentage to 3 decimal places. I'm then going to start adding some borders to all of this stuff. So let's add some borders to every cell in this table from D3 down to M25. So I'm selecting all of those cells. I'm going to go within the Home tab on the ribbon. I'm going to put in all borders in the border drop-down menu. And then I'm going to do the same sort of thing for this table over here. All borders. Then I'm going to use some thicker borders to kind of split this table up. You'll see what I mean in a moment. So first of all, I'm going to select these cells here, D2 to E25, and then go to our border drop-down menu and click thick outside borders. The same for this selection here from F2 to I25, and the same for J2 to M25 as well. And finally, for this table, I'm going to select everything from D3 to M25 and do another thick border, and then color all of these cells in a slightly different color. Let's make it a light blue. I'm just doing this as an example. You could put any color in here and you can change the colors of the different columns if you wish, anything like that. You can also actually make these tables into heat maps. So you could select all the values in these cells, go to conditional formatting, color scales, and choose any color scales you like, and that will kind of highlight which assets have the most volatility and which time frames. You can do anything like that, just have a little experiment. And we'll do a similar thing just for this table over here. So I'm going to add a thick border around the whole thing, and another thick border kind of just here from cell 03 to S8. And tell you what, we will do a heat map on this table just so I can show you what it's like. So I'm going to select cells P4 to S8, and then go to conditional formatting on the Home tab, go to color scales, and then I'm going to choose this second option here, where red is the cells with the highest values are red and the lowest values are green. And there you go. That shows us quite obviously that the most volatile asset classes that we're looking at, and assets in general that we're looking at, are mid-cap equities on a quarterly horizon. And you can see how very easily both the time horizon and the asset class of the asset that you're looking at, or the type of asset that you're looking at, really affects both the volatility and the risk, but also the opportunity in trading that asset. So as I said, you can play around with the design, do whatever you like. I'm just showing you a few examples, the sort of things that you can do in Excel. It's up to you guys to build your own sheets and customize them the way you wish. I hope that you've got enough information from this video to kind of do that and tackle that yourselves. I think these summary tables are important for you guys to kind of build, because whereas the individual distribution of return sheets are useful as a sort of a deep dive into understanding how a particular asset behaves over certain time periods, building your own summary table is almost more important. Obviously, you have to do the first bit to be able to do the summary table, but it's almost more important in giving you a really quick visualization of which assets and which asset classes are more volatile, and hence kind of own the risk and both opportunity of trading them. So that's it for this video. It's been a long one. Well done for getting through it. I hope it's been useful. Make sure you look over this video in combination with all the PDFs. That's going to help you get through it the easiest and learn the most and take the most from it. And pretty sure all these pieces are soon going to fit together and your competency is really going to improve.
Okay, so welcome back to the desk. Obviously, since we were last at the desk, you've seen a hell of a lot of information. And yes, it's a lot to take in. We are aware of that. We are aware that trading is a difficult pursuit, and doing it the right way, the professional way, is going to be a lot of work. So there's a lot to take in, but don't worry about it. You're going to get used to it the more you stick at it. So what have we been over here? Well, we've looked at realized historical volatility, and we've looked at one of the main methods of calculation for realized historical volatility, which is the DOR analysis, our distribution of returns analysis. And we've looked at how it's calculated and why it's so important to professional traders. So let's summarize. Why is it so important? Well, firstly, we can use distribution of returns analysis across all asset classes of publicly traded instruments, so in different areas of financial markets, to literally define our strategy as traders. What did we look at? Well, we looked at the four main asset classes. So we looked at equities, commodities, bonds, currencies, and we are looking, obviously, as traders, when we're utilizing a method like distribution of returns, we're looking for areas of the market that present consistent volatility and wholesale opportunities. We are looking for our tradable set to be as large as possible and for consistency in volatility. So this method of the distribution of returns calculation helps us do that. It literally helps us define our strategy as traders. We want to be in areas of the market that provide wholesale opportunities. We like volatility because we like opportunities, and we embrace it. Where do we find it? Where did we find it when we did the calculations? We found our wholesale opportunities in mid and large cap equities and in the 1 to 3 month time horizon. And we literally proved it, guys. We've proven it with historical data. We proved it with the numbers. This is where we need to be. This is where we need to be concentrating our efforts. So the distribution of returns analysis provides us with these calculations and allows us to literally define our strategy as traders. Our strategy is long-short portfolio management, 1 to 3 month time horizon in the equities market, focusing on mid caps and large caps. Secondly, distribution of returns as a method for calculating historical volatility. It allows us to choose the level of risk that we want to take. And it allows us to be on top of our risk. So what do we know when we calculate the volatility of a single asset? We know the risk of that asset. We know the opportunity of that asset. The point here is, guys, is that through methods of calculation, like distribution of returns, we see a key difference between pro traders and retail traders. Pro traders know their risk. Pro traders know their opportunity. Retail traders don't. They're not on top of it. They don't know their risk. They don't know their opportunity. They're going in blind. That is a big difference. So the distribution of returns analysis allows us to be on top of our risk and on top of our opportunity. We're literally choosing the level of risk and opportunity that we want to expose ourselves to. Now, thirdly, what else does the distribution of returns analysis allow us to do? Well, if it's possible to calculate the risk and opportunity, the volatility from the historical data of a single asset, then it stands to reason that if we can do that for a single asset, we can do it for multiple assets, and therefore we can do it for a portfolio as well. So we can use or utilize a method like the distribution of returns calculation to calculate the risk and opportunity of multiple single assets at any one time. So it stands to reason that through other methods, we could extend this analysis to actually calculate the risk and opportunity of portfolios. And yes, we can do that. And we're going to do this later on in the video series. We'll come to that soon. But Chris showed you the method for calculating now the distribution of returns of a single asset, of any asset out there that's publicly traded and that you can actually get the data for. So you can do this now forever using daily, weekly, and monthly data to assess the volatility over multiple different time horizons. So you can literally calculate your risk and opportunity. You're going to know your odds. You're going to know your downside. You're going to know your opportunity. You're going to know your risk, your downside. You're going to know your opportunity upside. So on any single asset, you will know the historical volatility profile of any publicly traded asset. This is seriously useful information, and you're going to use this for the rest of your life. So obviously there's a lot of spreadsheet work, and there's PDFs downloads and spreadsheet downloads. We want you to use them and learn the methods. It takes a while to get used to doing this. You need to get to a point where you can do this easily yourself with your eyes closed. You can do it forever very easily. So please use the methods and get used to it. Now, as mentioned, later we're going to be looking at portfolio volatility as well. But we're also going to be looking at implied forward-looking volatility as well. So later we'll look at implied volatility, forward-looking volatility, and portfolio volatility. But for now, we're going to look at another method of realized historical volatility. We're going to look at something called the average true range percentage method, the ATRP, average true range percentage method. So we're going to do that in the next video. So let's go over to the next video.